Today we are covering the Additional Medicare Tax, a concept that frequently appears on the enrolled agent exam through scenarios designed to trap unprepared candidates. This is a 0.9% tax levied on earned income that exceeds certain filing status thresholds. The key numbers to memorize are $200,000 for single, head of household, and qualifying widow filers, and $250,000 for those married filing jointly. The threshold for married filing separately is $125,000. This tax applies specifically to Medicare wages, self-employment income, and Railroad Retirement Tax Act compensation. It does not apply to investment income, which is a common point of confusion with the net investment income tax. The exam will test your understanding of the mismatch between an individual's tax liability and their employer's withholding requirements. This is the most critical area to master. An employer is only required to begin withholding the 0.9% additional Medicare tax once an employee's wages paid by that employer exceed $200,000 for the year. Notice that this is a single, universal threshold for the employer's action, and it completely disregards the employee's filing status or income from other sources, like a second job or a spouse's earnings. Let's walk through a classic exam problem. A married couple files a joint return. One spouse earns $210,000 in wages, and the other spouse earns $100,000. Their combined wages are $310,000. Their filing threshold is $250,000, so they owe the additional Medicare tax on the $60,000 excess. This results in a tax of $540. Now, how much was withheld? The first spouse's employer began withholding the tax only after their wages crossed the $200,000 mark. So withholding was applied to $10,000 of their salary, for a total of $90. The second spouse's employer withheld nothing because their wages never reached the $200,000 trigger. The couple had $90 withheld, but owe $540. They are responsible for the remaining $450, which must be paid either through estimated tax payments or by having more income tax withheld via their Forms W-4. The exam loves this scenario because it creates an under-withholding situation purely based on the rules. You will report and calculate this tax on Form 8959, Additional Medicare Tax. For self-employed individuals, the calculation is similar. They combine their net earnings from self-employment with any wages to see if they cross the threshold. If they do, the 0.9% tax applies on top of their regular self-employment taxes. A key detail is that the additional Medicare tax is not deductible as part of the 1/2 of self-employment tax deduction. To remember the most confusing part of this rule, use the phrase, 200 is the trigger. This mental shortcut reminds you that the $200,000 amount is the universal trigger for the employer's action to withhold, which is separate from the taxpayer's ultimate liability calculated from their filing status threshold. Focus on this employer-employee disconnect, and you will correctly answer the exam questions.